Hello, so you're welcome to this lecture on IAS 40, investment property. Investment property. At the end of this lecture, you should be able to define investment property and especially differentiate investment properties from PPE, property, plant, and equipment, because there is property in PPE and there is investment properties. Okay. Then you should be able to outline the characteristics of an investment property. What constitutes an investment property? To discuss why the treatment of investment property differs from other properties, to outline the recognition criteria, to explain subsequent measurement, and to outline disclosure requirements. Now, when it comes to disclosures, you will read this for yourself. When it comes to disclosures, it is your reading assignment. So you must know what the disclosure requirements are for IAS 40. Now, the objective of the standard is to prescribe accounting treatment to investment property and related disclosures. So the standard is about how to account for investment property. So you must first define, identify, and then account, and then the disclosure requirements. The scope, what the standard deals with, what aspects the standard, what kind of property the standard deals with. This standard shall be applied in the recognition, measurement, and disclosure of investment property. Applies to the measurement, and when you read it this way, applies to the measurement, it means it doesn't apply to the recognition. Here, look at the first point. The standard shall be applied in the recognition, measurement, and disclosure. So, in the second point, it only applies to the measurement in a lessee's financial statement of investment property, interest held under a lease accounted for as a finance lease. So we'll deal with leases as part of your lessons this semester. So we'll come to leases and we'll understand this. And applies to the measurement in a lease's financial statement of investment property provided to a lessee under an operating lease. So again, it applies to the measurement of a leased item, a leased property. What it does not cover. So when we talk about the scope is what it covers. So this will be seen as scoped in. Scoped in. This is scoped out. What it does not cover. It does not cover the classification of leases as finance lease or operating lease. That will be dealt with under a standard called IFRS 16, which you will be studying this semester. Recognition of lease income from investment property. If you read the old standard, they will tell you IAS 17, but IAS 17 is no longer in use. We are using IFRS 16 for leases. So take note of it. You will be reading IFRS 16. So anywhere you read IAS 17, replace it with IFRS 16. So you need to identify those items that the standard does not cover. Now let's deal with the definition, because you have to understand investment property to understand why it is different from properties in PPE. Now, investment property is property. And it is land or a building or part of a building or both. Investment property is land or a building or part of a building or both. That's an investment property. Held by the owner or by the lessee and the finance lease. You understand lessee and the finance lease very soon. But for what it's worth, think about it as held by the owner. So if you have a building or a land, you are the owner and you are holding this building or land to earn rentals or for capital appreciation, then you have an investment property. So investment property is a property held to earn rentals or for capital appreciation. Capital appreciation is increase in the value of the asset. If you have an asset, you bought the land today at 10,000, and you can, when you keep a land for some years in a very prime area, in a very good location, a year or two after, its value increases. That's what is called capital appreciation. So you may acquire land, you will not do anything on the land, you just keep the land there, and then after some years you sell it. So it means you are holding it for capital appreciation. So if you have an investment property which you are using to earn rentals, or you are using for capital appreciation, or for both, which means you have the property and you are renting it and you are also holding it for capital appreciation, then you are holding an investment property, and you are not holding it for the use in the production or supply of goods or services or for administrative purposes. If you are holding property for these reasons, then it is PPE, or sale in the ordinary course of business. So if you are holding property for sale in the ordinary course of business, then you are talking about IAS 2. So that's how you define investment property and differentiate it from other property. So this is just to emphasize that there are other property, but the ones that are called investment property is a property that is land or a building or part of a building or both, held to earn rentals or for capital appreciation, and they are not being used for these other purposes. So you have examples: land held for long-term capital appreciation rather than short-term, land held for currently undetermined future use. If you have the land and you don't know what to use for it, you will be applying IAS 40, investment property. So a building that is vacant but is held to be leased out is also investment property. So here you are looking at examples of investment property. Examples of investment property. So in your reading, you must learn to identify what an investment property is, and examples of them. Now let's talk about the accounting. The recognition. Investment property shall be recognized as an asset when and only when it is probable that future economic benefits that are associated with the investment property will flow to the entity, and the cost of the investment property can be measured reliably. This is normally recognition criteria for assets. So if an asset meets this, then it will be recognized. Initial and subsequent measurement. For investment property, initially you measure it at cost, including transaction costs. Investment property, initially you measure at cost, including transaction costs. And that cost should not include startup cost, abnormal waste, and initial operating expenses. It doesn't include that, right? Then subsequently, after the initial, after day one, at the end of every year, the entity has two options: either fair value model or cost model. Fair value model, cost model. Now, cost model is according to IAS 16, so we don't get to discuss cost model. It is cost less accumulated depreciation, less accumulated impairment. So that is cost model, and it is exactly how it is under IAS 16. So we don't get to talk about cost model here, but we will discuss fair value model because it is under IAS 40 that we talk about fair value model. And I've explained earlier that fair value model is not the same as revaluation model. Revaluation model is under IAS 16. Fair value model is under IAS 40. And you need to understand that under both fair value model and revaluation model, the property is fair valued. The property is fair valued. Under revaluation model, the property is fair valued, but the revaluation gain is accounted for differently. Under IAS 40, the property is fair valued, but the fair value gain and loss is accounted for separately. So the fact that an item is fair valued doesn't mean it is a fair value model, or doesn't mean it is just revaluation model. You really have to know the measurement model that the entity is applying to the item and the kind of item it is. Fair value model. So we have agreed that property must be fair valued. You refer to current prices on active market, same location as condition. And this fair valuation speaks to IFRS 13, which you have already studied. IFRS 13. Now, when fair value is adopted, all investment properties must be measured at fair value. All investment properties, when you adopt, all investment properties must be measured at fair value. Asset is revalued to fair value at the end of each year. Gains and losses recognizing income statement, statement of profit or loss. Gains and losses. No depreciation. No depreciation. You only calculate depreciation on assets that are being used to produce goods or provide services. But investment property is not being used by the entity. It has been rented out or is being kept for capital appreciation. So no depreciation. And that's the difference between the fair value model, one of the difference between the fair value model and the revaluation model. And the revaluation model, gains and losses, OCI, gains OCI, losses profit or loss, unless it is to an earlier gain has been made on it, where you then hit the loss at the gain in the reserve, equity reserve, before any excess is recognized in profit or loss. So I am highlighting the differences between IAS 16 revaluation model and IAS 40 fair value model. They are not the same, even though under both methods you fair value the assets, you revalue the asset at the end of each year. But how you treat the gains under each model is different, and no depreciation under fair value model, but there is depreciation under revaluation model. So you must get these issues clear. Now, we keep talking about IAS 40 and IAS 16. They are that related, because if you have an investment property, you can use it as an entity for yourself, or you can give that property out in rental. And so at one point, the same property may be accounted for using IAS 16, and another time may be accounted for using IAS 40. So we talk about transfers. We talk about transfers where you transfer from investment property to um, property, plant, and equipment, or from property, plant, and equipment to investment property. And you only do that when there is going to be a change in use. A change in use. Don't forget, PPE is owner occupied or owner usage. By investment property is not owner. So if the owner is using it and decides to change, then it means it is moving from IAS 16 to IAS 40. If the owner had rented the property but now is coming to use it, then we're talking about investment property 2, owner occupied. So these are the circumstances under which transfers will occur, and you must know what to do when such transfers occur. Commencement of owner occupation, transfer from investment property to owner occupied property. Commencement of development with a view to sale, transfer from investment property to inventories. End of owner occupation, transfer from owner occupied property to investment property. Commencement of an operating lease to another party, transfer from inventories to investment property. So all these are the various circumstances under which there will be transfer from investment property to the use of another. So for example, the first point, commencement of owner occupied, is a transfer from investment property to owner occupied, which means you were initially using IAS 40, but you are now going to use IAS 16. Commencement of development with view to sale is a transfer from investment property to inventories, which means you are moving from IAS 40 to IAS 2. End of owner occupation, which means you were initially using IAS 16, but you are now moving to IAS 40. So those transfers are there and how to account for them. Now, change from owner occupied to investment property. What happens when you change from IAS 16 to IAS 40? Apply IAS 16 up to the date of the change in use. Revalue the carrying amount to fair value if fair value model is adopted under IAS 40. Account for the difference according to IAS 16. So when you revalue, you account for the difference according to IAS 16, which means if there is a revaluation gain, you recognize in OCI and in equity. Subsequent measurement is then at fair value because you were going to adopt fair value under IAS 40. And the gains and losses in statement of profit or loss. No change. If you were changing and you were going to use cost model, then there is no change in carrying value if cost model is adopted. There is no change in carrying value. Whatever carrying value you take from PPE is the same one that goes to, because it's a continuation. As far as IAS 16 and IAS 40 is concerned, if you were using IAS 16 and if you were using cost model under IAS 16, you are still going to use cost model under IAS 16, then you don't do anything to the carrying value because it's still cost model. Transfer of fair value investment property to owner occupy. The cost for subsequent period should be fair value. So if you were transferring from investment property to owner occupied and it is fair valued, your cost in IAS 16 should be the fair value of the asset. Disposal. An investment property shall be recognized on disposal or when the investment property is permanently withdrawn from use and no future economic benefit are expected from its disposal. Gains and losses should be calculated as the difference between the net disposal, how much you are receiving for disposing of the asset, against the carrying value of the asset. Now, I don't teach disclosure. You read it and I can examine you on disclosure requirement. That is why you should not ignore it. Every standard you read has a disclosure requirement. If you read a standard well, the disclosures come handy. So read it. It's part of the deal. Now, this is just a quick summary. You must go back and read this standard on your own. There are more issues than I can provide in the video. So everything you want to know will depend on how much you read on the standard. Thank you.